Something is happening in the silver market right now that most investors are completely missing. And by the time the mainstream media catches up, the move will already be over. The gold-silver ratio, one of the oldest and most reliable signals in all of precious metals investing, is sending a warning that experienced market watchers have not seen set up this way in years. And if history repeats itself even partially, what comes next for silver could be one of the most significant repricing events of this decade. So if you own silver, or if you have been thinking about it, you need to watch this entire video, because the window to position before this fully plays out may be closing faster than most people realize. Let us start with the ratio itself, because this is the foundation of everything. The gold-silver ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. When that number is high, silver is cheap relative to gold. When it compresses sharply lower, silver is catching up, and in those moments historically, the gains have been explosive. Back in April of 2025, that ratio reached approximately 105 to 1. That was a historically extreme reading, the kind of signal that does not appear often. And when it does appear at those levels, what tends to follow is a violent reversion toward the mean. That is exactly what happened. Silver surged over 140% through 2025, one of its strongest annual performances on modern record. Gold-silver ratio compressed hard, falling from 105 all the way down toward 58 to 60 by the start of 2026. Silver hit a nominal all-time high of 121.64 in January of this year. And then the correction came. Now pay close attention, because this is where the story gets serious. Silver has since pulled back roughly 34 to 40% from that January peak. As of this analysis, silver is consolidating in the $72 to $80 range, and price compression has been building between those two levels for weeks. A failed attempt at $89 in May created technical resistance above. Strong physical support has held near $72. The market is coiling, and when silver coils like this, the energy does not stay trapped forever. But here is what almost nobody is talking about. The pullback in silver prices has happened without any meaningful improvement in the fundamental supply picture. In fact, by most measures, the structural case for silver has gotten stronger during this correction, not weaker. The Silver Institute projects the 2026 supply deficit at approximately 67 million ounces. That would be the 6th consecutive year of structural market imbalance, 6 years in a row where the world consumes more silver than it mines. Think about what that means for a moment. Above-ground inventories have been quietly depleting for half a decade, and yet prices corrected because of Fed policy noise and a stronger dollar. The physical reality has not changed. The paper pricing mechanism temporarily dominated the narrative, but the physical market always wins eventually. COMEX registered silver inventory, the silver actually available for immediate physical delivery, sits at coverage levels that should alarm anyone paying close attention. March 2026, futures contracts represented over 528 million ounces of exposure, against roughly 113 million ounces of registered deliverable stock. That is more than 4 times the available physical supply sitting behind open paper contracts. And across global markets, the divergence between paper pricing and physical reality has been widening. Shanghai silver markets have been trading at premiums of $6 to $9 over Western COMEX benchmarks. Physical silver is flowing from London and New York vaults toward Asian buyers at an accelerating pace. Silver lease rates, the cost of borrowing physical metal for near-term delivery, recently hit their highest level since 2002. You do not see numbers like that in a market with abundant supply. You see numbers like that when physical scarcity is real and getting worse. Now, here's a number that puts all of this in context. Solar photovoltaic installations alone consumed over 200 million ounces of silver in 2025. And that figure is forecast to grow at 10 to 15% annually as global renewable energy targets accelerate. Add EV electrical systems, add data center infrastructure, add semiconductor fabrication, add medical applications, and you begin to understand that silver is no longer simply a monetary hedge or a speculative play. It has become a critical industrial input for the technology and energy transition that governments around the world have made legally binding commitments to deliver. Here is the detail that makes this alarming. Silver consumed in industrial applications is largely non-recoverable. Once it is embedded inside a solar panel, a circuit board, or an EV system, it exits the available supply chain permanently. It does not come back. This is fundamentally different from gold, where above-ground stock continuously recirculates through the system. Industrial silver is consumed and gone, and yet mining output cannot respond quickly because roughly 70% of silver is produced as a byproduct of gold, copper, and base metal mining. Higher silver prices alone are not enough to immediately trigger new primary silver supply. The inelasticity is structural, and it means deficits can persist far longer and go deeper than most models predict. This is exactly why smart money is moving early. Bank of America, in their February 2026 research, issued one of the most striking institutional calls in the precious metal space. Their base case projects silver in the range of $135 per ounce by end 2026. That base case assumes gold-silver ratio compression toward the 2011 lows near 32 to 1. If that scenario plays out, silver at $180 or beyond is not a fringe prediction. It is the mathematical consequence of the ratio compressing when gold itself is trading at multi-thousand-dollar levels. With gold having established an all-time high of $5,589 in January 2026, the arithmetic becomes very clear. A ratio of 32 to 1 applied to gold near those levels implies silver prices that would shock most investors watching from the sidelines. Citi's Precious Metals Desk has issued a $110 target for the second half of 2026, citing acute physical shortage of silver available for near-term industrial delivery. This is not retail speculation. These are institutional desks with research infrastructure that most individual investors will never have access to. What happens next could shock most investors. Let me walk you through the two core scenarios from here. In the bullish scenario, the price compression that has been building since mid-May resolves upward. A sustained close above the $89 resistance level would likely trigger significant technical buying and begin attracting momentum capital back into silver. The structural deficit compounds. COMEX delivery pressure intensifies as the June 2026 contract window progresses. The gold-silver ratio, currently sitting near 58 to 59, resumes its compression toward 40 and then lower. With gold remaining elevated, silver reprices sharply higher. The path toward $120, $135, and ultimately the $165 to $180 range opens up in a scenario where the supply deficit and institutional demand converge with collapsing ratio dynamics. That is the scenario that Bank of America's extreme upside case was pointing toward when they referenced the 1980 Hunt brothers squeeze geometry applied to modern gold prices near $5,000. In the bearish scenario, the dollar strengthens further on Federal Reserve hawkishness, suppressing dollar-denominated commodity prices. The $63 support level fails to hold. Silver enters a corrective phase targeting the $50 to $60 range before reestablishing its longer-term structural base. TD Securities, among the more cautious voices, has suggested an average of $44 per ounce is possible if macro conditions deteriorate meaningfully from current levels. That scenario would require the structural supply deficit to somehow stabilize while investment demand collapses. Given everything we just walked through, that scenario would demand a set of conditions that appear increasingly difficult to reconcile with what the physical market is actually showing. Silver lease rates at 24-year highs do not point toward abundant supply. COMEX coverage ratios of 13% do not suggest a market with room to absorb sustained selling pressure indefinitely. But here's what almost nobody is talking about in the mainstream commentary. The real risk for investors is not volatility. The real risk is not being positioned before the next move reprices silver beyond the reach of the entry points available today. Every major silver bull cycle in history has had the same psychological structure. The metal surges. Retail investors who missed the move feel burned. Then comes the correction. And suddenly, the narrative shifts to why silver will keep falling. That narrative typically peaks exactly when the smart money is quietly building positions before the next leg higher. We are in that phase right now. The structural story has not changed. The deficit has not changed. Industrial demand has not changed. What changed is sentiment, and in silver, sentiment swings create opportunities that do not last long. Now let us talk about what you should actually be thinking about. Whether silver retests $72 or holds current levels, the medium-term setup has not fundamentally broken. 6 consecutive years of supply deficits do not reverse because of a paper futures correction driven by rate expectations. The ratio compression thesis remains intact. The industrial demand acceleration from solar, EVs, and data center infrastructure is not slowing. China and India, representing billions of buyers with an intensifying appetite for physical silver, are not stepping away from the market. Global power capacity for data centers has grown by over 5,000% since 2000, and silver is embedded in every layer of that infrastructure. This is not a commodity cycle story. This is a structural transformation story with a supply constraint attached to it. The investors who will look back at 2026 with the most satisfaction are the ones who did not let short-term noise override the long-term signal. The gold-silver ratio is one of the oldest, most battle-tested signals in all of investing. Right now, it is telling you that silver is in a transitional phase between a major compression move and whatever comes next. The compression from 105 to 58 was historic. But history also shows us that ratios can compress well below 50, well below 40, and in extreme conditions into the 30s before the cycle exhausts itself. With gold anchored at levels that would have seemed impossible a decade ago, the implied silver price at those lower ratio readings is not a fantasy. It is the arithmetic of where this market could go if the structural forces already in motion continue to build. Prepare early. Study the ratio carefully. Watch the COMEX delivery dynamics. Watch the physical premium data coming out of Shanghai. And watch whether industrial demand data from the Silver Institute continues to validate what the supply side is already showing. The window between now and when this fully plays out in prices is where the real opportunity lives. And by the time this is on the front page of every financial newspaper, the positioning opportunity will be gone. If this analysis gave you a clearer picture of where the silver market actually stands right now, subscribe to this channel and turn on notifications. We cover the precious metals market with the depth and frequency that retail investors rarely get access to. Drop a comment below with either gold or silver to let us know which metal you're currently focused on. And if someone you know is watching the precious metal space, share this video with them. This is the kind of context that changes how you see the market. We will see you in the next one.